fellow wealth builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Welcome to you, my family of wealth builders. This is episode 6, How Covered Calls Work. Now we're starting to get into the meat of things, pumping some blood into the heart of this whole podcast and what it's all about. And I'll tell you what, I am excited. I'm very excited. Some of you have experience with covered calls and might even have asked yourself, should I skip this episode? I probably know all this stuff. I want to get to the advanced concepts. Some of you have dabbled with covered calls and decided, maybe prematurely, these don't work. I always lose money or leave money on the table. Maybe I can learn something here in this podcast. And some of you are new to this style of investing and have your notepads out. And, well, if you have your notepad out, I hope you're not driving. I listen to podcasts when I'm driving sometimes. Don't do that. But either way, whoever you are, whatever experience you have with covered calls, you are in the right spot. Listen, whatever you were thinking when you started streaming or when you downloaded this episode, well, first, I'm glad you're here. And second, I want you to know that it is going to be worth it. We'll definitely cover the basics. And in every episode, we're going to talk about covered calls, or sometimes their close cousin, cash secured puts. And a lot of times we'll talk about both. Humans learn by repetition. Like baseball players who've been playing since they were 6 years old and have been in the majors for a decade, well, they still go to the batting cages. You pick up little details, little nuances. Fundamentals improve you. Repetition improves you. Repetition improves you. As far as where you are in your options investing journey, I always say there isn't basic, intermediate, and advanced options lessons. There's what you need to know to make money, and, well, that's it. So when I find myself introducing how a strategy works, I inevitably weave in some ideas that are considered more advanced because you need to know them. And you know what else? This stuff, covered calls, this stuff is easy, but this stuff is hard. I've been breaking covered calls down into their first principles, their most basic form, for literally decades. That's how long I've been teaching this, let alone trading it. You learn by teaching. I have learned by teaching and continue to do so. If you have a lot of experience with covered calls, or even if you have just little, here's a great way to benefit from this episode. Take my explanation of covered calls today and talk to somebody about it. I encourage you to share this podcast with like-minded people. This helps you. You'll have someone to bounce ideas off of, someone to teach so you can learn, and it also helps grow this community. There are two ways you can help grow this community. And first, I already mentioned the one, like I mentioned, it's to tell someone about it. Word of mouth is so important for podcasters. And the second thing you can do is, would you please leave a review on Apple or Spotify or whatever podcasting platform you listen on? That helps us so much. It helps the algorithms push out the content to more people. And listen, for your effort, I want to return the favor and give you something great when you post a review. So here is what I'm going to do for you. If you're listening to this episode, leave a review on Apple Podcast or Spotify or whatever you listen to your podcasts on. And after you post your review, take a screenshot of it and go to wealthbuildingwithoptions.substack.com. That's wealthbuildingwithoptions.substack.com and paste the screenshot of your review in the chat. Leave your name, and we'll send you a strategy guide called the Covered Call Strategy Guide for free, just for posting the review. This is the best way I know to help you continue to further your covered call mastery while helping build the Wealth Building with Options community. And I thank you for it in advance. I really, really, really appreciate your help in growing our community. Okay, here we go. Sit tight. Or if you're driving, hit cruise control. Or get into your running gait. Or relax in your chair. Whatever it is you do when you listen to podcasts. Let's talk covered calls. What I will share about covered calls on just this one episode, just this one show, is the subject of many full-length texts on the subject. But the reality is you only need about 20, 30 minutes of explanation to acquire the knowledge you need to understand how covered calls work. This is the easy part. And this is kind of part one of a 2-episode show. The next show in this 2-episode series is, well, this one's how covered calls work. The next one is going to be why covered calls work. And that is going to be a really, really great one. Seriously, there's a lot of cool stuff that most covered call traders never knew or don't think about that I will share in that episode. Though that will be 2 shows from now. We have a special episode next week that I will tell you about later. Covered calls in and of themselves, they're not difficult to understand, but it's often difficult for the common investor to harness the tactical skills and the intrapersonal soft skills required to harness the market-beating outperformance that's possible by using this time-tested and academic-tested strategy. Once we cover the how and why covered calls work, we'll do the same for their close brethren, cash-secured puts. So, covered calls. A covered call is easily constructed. The position consists of 2 parts or legs. Long, owning 100 shares of a stock or ETF, and short, 1 call option on that stock or ETF. So the call is said to be covered because a short call by itself has limited profit potential with unlimited risk. Let me say that again. A short call, naked short call, so just by itself, has limited profit potential and unlimited risk. You can only make what you sold it for, but the risk is unlimited. So owning 100 shares of the underlying along with the short call covers that unlimited risk. So let's explore this for a moment. Recall that selling a call incurs the obligation to sell 100 shares of the underlying at the strike price if the call is assigned. The call seller gets to keep the option premium regardless of the outcome, thus the premium is the maximum profit potential. But if the call is assigned, the trader now becomes short 100 shares, which short stock theoretically has unlimited loss potential because the stock can just rise infinitely. There's no cap. Or even, to be fair, if the call is not assigned, once the stock gets so high above the call strike price that it consists of all in the money value and is consequently a negative 100 delta, we'll talk more about that in the future, it's still unlimited theoretical risk just on the call, whether it's assigned or not. So owning the 100 shares offsets the theoretically unlimited loss of the short call if the stock goes up a lot. Thus, adding the stock swaps the theoretically unlimited risk for the limited risk of owning the shares. So the trader has the risk of the stock going down too much then. So to be fair, like the absolute risk of owning stock is like, I mean, it's still theoretically big, but look, like you probably have invested in stocks before maybe, or at least if, you've generated a nest egg or something. Investors are generally comfortable owning stocks as a tangible investment stake. So to that point, one could argue there's more risk to the stock going to zero than to infinity. Because I have seen stocks go to zero, but I have never seen one go to infinity. And it's kind of weird to think about, but like bigger moves happen when the market moves lower rather than when it moves higher, statistically. So if you philosophize about this too much, you might end up scratching your head a little bit. But the idea is that the stock is paid for, or at least bought on margin, by putting up half the money, presuming the trade is in an account that allows for buying stock on margin. A lot of times covered calls and cash secured puts are traded in IRAs, which you can't do that. But the effect on risk then is the covered call gets rid of the leveraged risk, the risk of losing more than is in the account, which is possible with the so-called naked short options, naked short call. And, it's still it's still a little weird to me. It's probably weirder to me than to other people for some. Well, I know the reason, because like I had an atypical start to my career with options. I made my first options trade as a professional, not as a retail trader. I didn't work up from retail trader to professional. My first trade was in the OEX pit on the floor of the Chicago Board Options Exchange. So I never thought about options in terms of using them for investments. I thought of them as trades from the get-go. And it was just like, up, down, both are risk. Volatility is risk. Time decay is risk. So I never really looked at it that way. So when I first started even learning about covered calls, when I was a retail, I traded them down on the trading floor. Usually they were called buy rates because you trade them at the same time. More on that later too. But when I first started actually trading covered calls as a retail person, I thought they were kind of strange. Talk about them being very conservative. And I was thinking to myself, well, they're 100 delta, they're not 100 delta, but they're a big delta. If the stock goes down too much, you're in trouble. But I finally ended up wrapping my head around the idea that, oh, look, I have an IRA where I own shares of stock. Oh, well, yeah, that's what I do as an investor. I own shares of stock. So adding the call to it actually makes that less risky. Arguably, it lowers the standard deviation. So anyway, that was just a quick little digression here, but the scope of this whole show really is on covered calls as an augmentation for long-term investments. So mainly we'll discuss covered calls, also called an overwrite, in the context of selling a call on a stock the investor already owns. When an investor buys the stock and sells the call as a single trade, that's when it's more commonly referred to as a buy rate. And man, I will tell you what, there are a lot of ways to use covered calls. There's a lot of different ways, and we're going to talk about all of them, probably a whole bunch that you never even thought of. I was just talking with someone that I work with literally the other day before recording this episode, and he's been a trader longer than me, pro. Not really so much in options, but more in futures and ETFs and such. And we were talking about covered calls, and he's like, yeah, well, you usually do them on shorter term options, right? And my answer is yes, I usually do them on shorter term options. But it was funny, just earlier that day, I put on a trade where the call that I sold against the stock had like 280 days until expiration, like 80% of a year. And so we ended up talking about that for a bit. And that one I actually traded as a buy rate. And I don't do a lot of those, but every now and then it makes sense. Another thing with covered calls, and I know I didn't even introduce covered calls yet, but I just want to give you an idea, just the flexibility and just the variability that this thing called covered calls can do. Usually what we do when we sell covered calls, which again, I'll tell you about in a minute, is we sell out of the money covered calls, has a higher strike than where the stock is. But like one of the smartest traders that I know worked for one of the major banks and was one of the bank's major traders. Our kids were on the same, what do they call it? Little League T-ball or whatever league. And he retired at 35 or something. And I was like, oh, so, what are you doing these days? He's like, oh, I'm just managing the family's portfolio and I sell a lot of covered calls. I'm like, oh, okay, cool. What's your methodology for selling covered calls? And he's like, oh, I sell a lot of in the money covered calls. I was like, wait, hold on a second. What? This is one of the smartest traders that I know. Selling in the money covered calls. I never even heard of anybody do that. But that can be a really great way to do it as well. And we'll talk about that too. And also, covered calls can be part of bigger positions like the stock repair strategy. And there are variations of it, like buying a long-term call instead of buying the stock, which we call a diagonal or a poor man's covered call. Arguably, even a call debit spread is a lot like a covered call, almost synthetic. Speaking of synthetic, there's synthetic relationships when it comes to covered calls. I mentioned cash secured puts. Those are actually synthetically identical, the exact same thing. So I know I got a little bit ahead of us and I digressed a little bit, but the people who are a little familiar with covered calls here, they're just, I don't know. They're in some ways one of the most basic strategies, but they're still one of my favorites. And when you get really good at them and dial in some of the things that we're going to talk about throughout this podcast season, oh man, I love them. All right. So let's look at how a covered call trade works. Consider this example. Imagine you own 100 shares of a company called WXYZ. So you own 100 shares of WXYZ stock. Now, by the way, if you've heard me on other podcasts in past years, or you've taken classes or you read books, you're probably used to seeing XYZ stock, right? XYZ stock. That has been the quintessential example ever since I heard of an option in the early 90s for me. They've been around longer than that, but I haven't, at least in this career. But just recently, there was a company that changed their stock symbol to XYZ. And that just it ruined all the textbooks. Oh man. So I figured I'd stay ahead of them a little bit and I would change my stock symbol to WXYZ because that one still is not taken. So if anybody's going to form a company and you call the stock symbol WXYZ, oh man, I don't know what I'm going to do. But you own 100 shares of WXYZ stock. It's in your IRA. You bought these shares yesterday or last week or last month or last year, 20 years ago. It doesn't matter. But right now, the stock is trading at $119 a share. Nice round number. We're going to make it easy here. In this example, you don't think that the stock will be that volatile between now and the next regular monthly expiration, which is in this example, May expiration on May 17th. You're not concerned about the stock falling much. If it does, you're planning to hold on to it anyway. You observe that it's had some resistance on the stock chart at $122 a share, which means that in the recent past, if the stock was going up and it looked as if it was going to continue to rise above $122, nope, it would get stuck there and bounce back down lower as if some invisible line at $122 a share was pushing it down from that price. So you figure that'll continue. You figure the stock will stay below $122 between now and May 17th expiration. You decide, and reasonably so, that this might be a good candidate for a covered call. Given your assumptions about the stock price, you don't think that'll go above $122, and the time horizon between now and May 17th, you decide to sell one May 17th 122 strike call, which you can sell at $1.50. This completes the second leg of the covered call. The other leg is being long the 100 shares of the stock that you already own. Okay? Makes sense? This is owning 100 shares of WXYZ stock and selling one of the WXYZ May 17th, 122 strike calls at $1.50. And of course, reminder, we're selling one call because each one call represents the rights on 100 shares. So let's compare this two-legged covered call position with simply owning the stock outright. Just owning 100 shares of WXYZ stock is a pretty easy position to understand the profit or loss of. Stock is what I call a linear investment. And I call it that. I had a good friend many years ago, and he worked for like one of the biggest trading companies in the world. It might be, what is it? It's not Goldman Sachs, but it's one of the biggest. I mean, Goldman Sachs is just like a gigantic bank that has trading arm, investment banking. This is more like, it's a big trading firm that you know the name of. So my friend worked there in accounting. He was like the head of energy product accounting. And so we would talk every once in a while about trading and the market and derivatives and that kind of thing. And he would talk about, linear products. And I was like, what's a linear product? And he's like, well, like a future or a stock, like it can go up or down. Whereas options, there's so many more things going on, as we'll explore. So anyway, on the 100 shares, if the price goes up by $1, the shareholder makes $100. $1 times 100 shares. If it goes down $1, the investor loses $100. Straight line, straightforward. But when you add that position, that 100 shares, and you add the call to it, it fundamentally changes how the position as a whole functions. Now, it helps to try and visualize what I'm talking about in your head, all right? So think about this. If you own the 100 shares, which is at $119 right now, and at the same time are now short one of the May 17, 122 calls at $1.50, the gist is that if the stock is below the strike price of $122 at expiration, the call expires. The investor keeps the $1.50 and still owns the stock, okay? So at expiration, if it's below 122, the call just simply expires. It goes away, but the $150 stays in your pocket. So here's the couple implications that has. So first, $117.50 would now be considered the break even of this position. That's because when the call was sold, the stock was at $119, and because you got $1.50 from selling the call, that means the stock can actually fall by up to $1.50, and the position as a whole still makes money. So below $117.50, the trade would be considered a loss. Calculating the break even relative to the stock price at the moment you sold the call is one way to measure the break even. And arguably, I mean, it's the way that it's always taught in textbooks. I teach it that way because it is a really great way to think about it. But, it's still a snapshot in time. I mean, frankly, if you sold the call 10 seconds later, the stock price would be a slightly different price. So I just want to point out, because this is going to be an important thing that we talk about much later in the season, we can also measure this break even relative to the cost that the stock was originally purchased. So both ways of looking at it are useful and are important. And we'll explore how each is important to your analysis in at least one separate episode, but probably more than one. We'll have a good handful of episodes on all the metrics that help you trade covered calls. As for now, the effect of doing the calculation using the original price of the stock when the call expires is that you can kind of think of the cost of owning that stock being lower by $1.50, right? So like you bought this stock 3 years ago and, maybe you bought it at $92.87. Well, okay, if you bought it at $92.87, you have this extra $1.50 that you made from the fact that you own the stock. So effectively you own it at $91.37, $1.50 less than what you originally paid for it. So that's like a different way of looking at it. We're factoring in or discounting the all-in cost of the shares by the call premium credit. Now, the most important thing to consider in the basic analysis is that the covered call position always outperforms simply owning the stock outright. Even if the overall trade loses money, it still loses $1.50 less than it would have having not sold the call, right? So does that make sense? So you own the stock at $119. You're collecting $1.50 on the 122 strike. Well, as long as the call expires and doesn't get assigned, and meaning you get short stock, which we'll talk about in a second, you get to keep that $1.50. If it's still at 119, you do $1.50 better. If it goes up to 120, you make $1 on the stock, but you still got another $1.50. If it goes down to 110, gee whiz, I lost $9 on the stock, but no, I didn't. I only lost $7.50 because I still have that $1.50. So that's what happens if the stock is below the strike price at expiration. Now, let's examine what happens if the stock is above the $122 strike price. The call is in the money. If the price of WXYZ stock is above the 122 strike price at expiration, on May 17th in this case, then the call would be assigned and the stock that you had would be sold or called away. That's why they call it a call. It gets called away at the strike price. So you're going to sell it at $122 a share, strike price. Now, equity options, stock options, ETF options that are in the money by 1 cent or more are automatically exercised by the Options Clearing Corporation, or the OCC for short. That said, the holder of the option can technically instruct the OCC not to exercise the call, which they would do only for a very good reason, and there are really only a few occasions for doing that. We'll talk about all that down the road. In general, if the short call is in the money by even a penny, it's very likely to get assigned, and that's going to be our assumption for now. So that said, an investor who overwrote the stock with this call we're talking about gets to keep the $1.50 of option premium collected, so the effective selling price of the stock, if it's above $122 at expiration, is actually $123.50, right? 122, the strike price where I'm actually going to sell the stock, but I've got that extra $1.50, so it's really the strike price plus the option premium, right? So if WXYZ is anywhere above $122 at expiration, the whole two-legged position makes $4.50. All right, so what's the math there? Well, you can look at it a couple of ways. You owned it at 119, and if it's above 122, you're effectively selling it at $123.50. So 123.50 minus 119, well, that's $4.50, right? And by the way, when I talk about break evens and effective prices, none of this has anything to do with taxes. All right, this is just the way that a trader's brain would think about these things. So, another way to look at this is, I sell the shares of stock at $122 minus the $119 where it was when I made the trade. So there's $3 plus, I get to keep the $1.50 premium. In some ways, that's a better way to look at it, maybe a little bit more clear too. So let's talk about now an example that maybe is a little bit more tangible here. Okay. So I actually recorded this episode a couple of weeks ago. I wanted to get a little bit ahead of schedule on a couple of things. And the market was pretty volatile at the time, which kind of changes things a little bit. Covered calls function a little bit differently at the time because options tend to get more expensive when the market's more volatile. So it's kind of a fun, interesting example. If I were to look at Amazon stock, which right now I'm looking at it, Amazon is at like $196.59. And, you know, maybe for whatever reason, and this is not a real example or anything, but I want it to be a little bit more real than WXYZ. So maybe I'm looking at this and I'm thinking, hey, you know what? Over the next, say, 10 days, I don't think it's going to go up more than like $15 to $210. It's kind of a hypothetical example, but, you know, well, if the market wasn't super volatile, it'd actually be a great example. But that's one of the ways that I like to think about it, is the percentage of the option price relative to the stock price. I'd be able to sell the 210 calls that expire in 10 days at $1.40. Okay. These are the 10-day Amazon 210 calls. They're $1.40 bid. If I were to divide that by the stock price, so divided by 196.59 at the time, that's like 0.5%, which doesn't seem like a lot, but there's like 3 10-day periods in a month. Bring in 1.5% a month, 12 months a year, you're doing pretty darn good. Not that it really works that way, because it doesn't, which is a big fallacy when people start thinking about annualizing returns. That's going to be an important thing we talk about this season. So basically, I would look at that and I would say, okay, well, I own the shares. I already own them. They're in my IRA. Wasn't planning on selling them. It went down a little bit, but markets fluctuate. I plan on holding it, but I might as well try and bring in some premium while I'm waiting for the stock to start making its way back up. And I don't think it'll get up to 210 over the next 10 days. That ends up making this a very viable covered call contract. And there's a lot of different strikes to choose from. There's a lot of different expirations to choose from, and all that's, you know, a whole different ball of wax. But that ends up being a pretty nice example. Now, there's a very commonly used tool to analyze the risk and reward nuances of option positions, and it's called a profit and loss diagram, or simply a P&L diagram. And sometimes people call it a risk graph. P&L diagrams, they're very easy to understand. They make option risk and reward super easy to get. If you can try and visualize this, think of like a sideways capital T, like the letter capital T, right? The top of the capital T is on the left-hand side. You know, like you draw it on a piece of paper. The top of the capital T is on the left-hand side, and then the body of the T goes like horizontally across. So these are the axes of a graph, of a diagram, right? The vertical one is the top of the T. The horizontal one is the body of the T. The horizontal one, the one that goes across the body of the T, those units would be the stock price specifically on May 17th, on expiration, all right? It's always a snapshot in time. You can draw, well, you can't draw, but I've seen computers create 3-dimensional ones where they factor in time, but, you know, that's out of the scope of what we're talking about here. So the horizontal axis is the price of the stock at expiration on May 17th. The vertical axis, the top of the T, that is the profit or the loss. Okay, below the horizontal line is a loss, above the horizontal line is a gain. So if we have a covered call, what we would have is something that looks kind of like an upside down hockey stick, where there would be a diagonal line going from the bottom left through the horizontal axis to the top right, and that would be linear. In fact, we could start there. We could just draw the linear stock price. Every dollar the stock goes up, you make $1. Every dollar the stock goes down, you lose $1. But then we would have this upside down hockey stick where there would be a parallel line above the stock price line, and in this case it would be $1.50 above it at all points up until it gets to $122, the strike price. That's where, because the stock is getting sold, it just levels off and it just goes horizontal because you're selling the stock at $122. And the profit would take into account that you sell it at $122, so you make $3 plus the $1.50. So that horizontal line, the bottom part of the hockey stick where you hit the puck, that is up at making $4.50. I hope you can kind of visualize that. I realize on an audio podcast, it could be hard to visualize for a lot of people. So here's where I'm going to present the best trade that I can give you. So I mentioned briefly earlier about my objective to grow this community. And one way we're able to do that together is for you to become a paid subscriber. We work hard bringing you these shows. There's a guy named Eric who edits them, and thank you, by the way, Eric. Bobby, who runs the backend on Podbean and Spotify and Apple, does all the technical stuff, helps keep it all going. Thank you a gazillion times over, Bobby. Kathleen helps make sure everyone knows about it. Newly released episodes are promoted through emails and social media and stuff like that. She does that. And you can help make sure we can all keep bringing you these shows and grow the community and really create something special together. So for around the cost of a drip coffee at Starbucks twice a week or one of the fancy Starbucks once a week, you can join Wealth Building with Options as a paid subscriber. When you subscribe, you're going to get bonus video extra podcast episodes where you get bonus content in video form that accompanies some of the episodes so that you could get more hands-on learning about everything we talk about on the show. Specifically, you'll get the video extra for this episode in which I show the P&L diagram and how it works so that you can actually see it. You'll also get invites for our monthly AMA, that's our Ask Me Anything sessions, where we do a live Q&A. Those are the third Wednesday of every month, and you'll even get a post a couple of times a week where I share all of my covered call and cash secured put trades, the real trades that I'm really making in my IRA with screenshots. And my colleague John even shares some other income generating trades too. It's really a really great value. And it's a great way to leverage your relationship with Wealth Building with Options, get more out of it, and help us keep it going to keep bringing you the best options investing knowledge we can. To become a paid subscriber, just go to wealthbuildingwithoptions.substack.com. That's wealthbuildingwithoptions.substack.com, and just click subscribe. There's a link in the show notes to that webpage, wealthbuildingwithoptions.substack.com as well. And like I said, in the video extra for this episode, we'll actually be looking at how to set up covered calls and also how to model them on one of these P&L diagrams, both in the context of looking at a brokerage account, because any options-friendly broker will have P&L diagrams that they draw out for you. And I'll also show you visually how to draw them out by hand, because I think that that's a really, really good learning process just to be able to do that. And that about wraps it up for the show. But before you go, get excited, get really excited for our next episode, episode 7, which is a very special episode with my good friend Greg Stevens from Fidelity. We're going to be talking about covered calls and how that can help investors generate wealth faster and so many topics. He's been in this industry forever and he's got really, really great things to share. I'll see you then, and in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.